Welcome to FinScale, a podcast created by Solen Niederkorn, shedding light on innovation in finance, banking, and insurance.
All about alternative assets. Bill Kelly, CEO and President of CAIA Association.
KKR came out with a recent fund offering. Very traditional alternative offering, private market offering, I think, in the healthcare space, Cayman-based fund. But this feeder fund's hanging off. And one of the feeder funds is on the blockchain. And I find that exceedingly interesting because the underlying asset, it's probably off-chain, tied to these portfolio companies, but the fact that it's on a blockchain where if investors want out, they have to gate the fund and raise liquidity. This blockchain offering, this feeder fund, they don't have to raise liquidity.
In this episode, we take a step back to understand what's taken place in private markets and in particular in private equity. You'll not only discover that this asset class was almost non-existent 40 years ago, but also be treated to a discussion on the main principles of diversification and the evolution of a pension fund's asset allocation. This topic is important because we know that there are huge challenges when it comes to accessing this asset category. We are therefore talking about financial education, but also about tokenization. We delve into ESG and Bill's views about how hard it is for asset manager to implement its principles. Finally, we talk about the CAIA Association, their programs and alumni, and their initiatives, which will give you deeper insight into how education and recruitments in tech are key to the development of this asset class. Enjoy listening. Hello, everyone. Hi, Bill, and welcome to FinScale.
Great to see you again, Celine. Thanks for having me.
I'm really happy that you accepted my invitation because last time I heard you was very insightful and very interesting. So I hope you can share as much information as you can today. But can you please introduce yourself?
Sure. So I'm Bill Kelly. I'm the current CEO and president of the CAIA Association, which we can maybe discuss in more detail in a moment. But I've held this role now, actually I'll be beginning my 10th year in another couple of weeks, which is hard to believe. We've been around for 20, so about half the life of CAIA. I've had the honor and the privilege to serve as the CEO of this organization. But I've spent 40 years in financial services. So I think this is a culmination of a lot of experience in a lot of different asset classes. And it's the very best job I've ever had.
Cool. You were investment manager previously.
Yes. So I started out as an accountant with Price Waterhouse at a school before PwC. It was the Big 8, not the Big 4, to show how long ago it was. But then moved to Boston from New York in 1988. And the vast majority of my career during that period of time was on the buy side of asset management. I was with the Boston Company, which was owned by Shearson, Lehman, and American Express, then sold to Mellon Bank before BNY Mellon. And I learned a lot about how to run an asset management firm inside of a large complex. Then 7 of us, without a paperclip to our name, started a firm called Boston Partners in 1995. So very much understood the venture capital startup space as well, firsthand as an entrepreneur, and sold that business to Robeco in Rotterdam in 2002. So got international experience as a result of that. And Robeco had acquired a few asset managers here in the States, and I became CEO of the U.S. operation. So a lot of different perches in the course of this career, and I learned a lot and took away a bit from every one of those experiences, which has served me very well today.
Excellent. Thank you very much. So I was very interested to have you on my podcast because you have a vision and a lot of information with regard to private markets and alternative investments. It's an asset class that I've seen as investment manager when I started at UBS like 20 years ago. That was still a very small and niche asset class compared to all the bonds and fixed income and equities, I would say standard asset classes of listed assets. This is something that maybe we can start with is that you explain to us how the diversification evolved those last 20 years.
Sure. So the concepts of hedge funds and private capital have been around for decades. And I think the first hedge fund started in the 1940s. So these are not new terms, but I think in terms of moving toward Main Street, these concepts are maybe a little bit new and maybe very much misunderstood. But if I look at the beginnings of the endowment model, which is really diversification across the traditional space, stocks, bonds, and cash, that was brought forward by the Common Fund, believe it or not necessarily the big Ivy League endowments and not necessarily David Swensen at Yale. Swensen perfected the model. But the concept was, if I look at the liability side of my balance sheet, and the principal is not going to be drawn more than maybe 5% every single year, it allows me to invest much more long-term and capture, as the story goes, an illiquidity premium, a complexity premium, and off you go. And the endowment model was born this way. And there are great inefficiencies in that market. And if I'm thinking about capturing alpha, it's found in pockets of inefficiencies. And when I last saw you in Luxembourg a couple of weeks ago, I did stop at 3 different universities in that tour, which I love talking to these students. And this very topic came up with them. And there's a chart I use when I talk to the students all the time just to show the growth of this space. And this is data that Preqin put out in the early 1980s. When I was beginning my career, there were 24 private equity general partners in the entire world.
No, you're kidding.
So yes, and now we probably have 24 were created just in the course of this podcast. So if you think about one of those 24, the ability to go and source product and source portfolio companies was just awesome. It's gotten much more complex, much more difficult, and we're certainly going through at least a growing pain stage. Some call it a bubble. I don't know if I necessarily would ascribe to that. But I still think there's a lot of upside opportunity. But where we are at this point in the market, I think at least the yellow light of caution is flashing, where if you're going to treat private equity as if we were back in the 1980s with just 24 general partners and they were going to get you an outsized return, not true anymore. The median returns look like the public market proxies, and this concept of dispersion, what the average managers earn, dispersion from that median up to the top quartile, separated by thousands of basis points. So it's really come down to a sector selection, manager selection, and due diligence is critically important.
And why is there now such a growing interest for alternative investment? And if you could maybe take 2 minutes to explain what means for us and what represents alternative investments.
So the second first, so what describes an alternative? The answer is it depends. And I'll give you a broad definition, which is anything other than stocks, bonds, and cash, which are in the traditional bucket. Everything else is an alternative. But I do, in some respects, accept the name because it's in the name of CAIA, Chartered Alternative Investment Analyst. But I also reject the concept at the same time because every investment opportunity is an alternative to something else.
Yes.
So, and I think that's how investors, smart investors, think about it, not traditional versus alts. But maybe to answer your question specifically, we focus on the institutional quality alternatives. So by that, meaning what would a big pension plan, sovereign wealth fund, endowment, or foundation invest in? So cryptos is an example, or digital assets for the most part are considered alternatives, but they don't have the size and the scale and the development of due diligence and custodial aspects that are institutional quality. So we define it, broadly speaking, as real assets, which is natural resources, commodities, real estate, infrastructure, the private markets, which covers everything from buyout all the way down to venture capital and private debt, hedge funds, certainly a big part of this as well, and structured products. So you could take a commodity and or any kind of offering in that space through futures and managed futures to create a structured product around it. So it's really what the institutions are looking at beyond the traditional space. But I said the definition can be very, very wide. It could include wine, baseball cards, art, and those are more germane maybe to the mass affluent up to the single family office.
And why has it improved so much? Because I can see it. I see it on my professional experience, the rising of that asset class over the years and the booming those last 10 years with the incredible size of assets under management, even just in private equity or in venture capital. How can we explain this? Why has it been growing so much?
Well, I think there's a collision of a few things, and I think maybe most notably the global financial crisis, and coming out of the other side of that in 2008, central bankers around the world just dumped liquidity and pinned rates to zero. So if you're doing any kind of a leveraged equity play in a risk-on trade, it is just an awesome place to be. So private equity grew quite rapidly coming out of the GFC in terms of funds raised, funds invested. But what also went up is the multiples of cash flow, which if you want to buy low and sell high. So before the GFC or right around that time, the multiples of portfolio companies coming into the GP space, the general partner, were probably 8 times cash flow. And now they're 12 to 15. And in the tech space, sometimes over 20 times EBITDA on the way in. In the course of my career, and maybe yours, Celine, those used to be pretty good exits. So these are the numbers on the way in, and these returns are being levered up. So it has been a great run, but there's been a lot of press and popular opinion around, are we in a bubble or not? And as rates are rising, the stress of some of these underlying companies are going to be challenged, where valuations and marks are happening, and are they coming down as quickly as the public market proxies? So there's been a lot of debate about transparency in the private market space as well. But maybe the last point in this is that I am fearful to some degree about investor expectations because equity risk premium is equity risk premium. I could get it in the public side, I can get it in the private side, I can access it through options, through a hedge fund. But at the end of the day, equity risk is more or less the same. So if you're unhappy with the public market returns, which don't look very good, and you're going to go and think you can dial up a private market outsized return, it's pure fallacy. Are there opportunities for the right manager in the right sector? Yes, but you've got to work very, very hard to do that. And unless you have an intermediary, a skill, and access, I would say you shouldn't be playing in the space in the first place. So I still think we have a lot of running room, but I think we're going to be in a challenge period, at least for the foreseeable future. We've got to ride out this next wave of whatever the global financial issue du jour is going to be.
Interesting. And if we take a look at the asset allocation of big pension funds, were private markets the main performance drivers those last years?
Historically, they have been. But again, I think we're going to see more of a challenge. And I think there are a lot of plans that are trying to allocate more to the private markets on the one hand, but then this concept of the denominator effect, where if you've had a drawdown in the public equity markets that has moved maybe down 20%, you've got to rebalance that back up to your target weighting. So I think we're seeing a lot of these pension plans around the world selling out of some of the private market opportunities to bring that number down and top up their public market allocation. I think that presents challenges to some plans, but opportunities as well, where maybe some of the current vintage of private equity or private markets in general has challenges, but it might be an interesting opportunity to get into a vintage from 2017, 2018. So there's greater diversification there. But also I think there's a lot of thought that the 2023 vintage could be very, very good because now the multiples have come down. There's a lot of dry powder as well. So again, I think private equity manager selection matters a lot, and vintage year matters a lot too. So I think there's going to be maybe a mixed bag. I think people selling for reasons maybe they don't want to be selling, and then investors coming to private equity thinking that this is going to be the home of outsized returns, when I think you just got to be very, very careful. As I said earlier, I think there's a yellow light flashing, and which usually means proceed, but proceed with a lot of caution.
And how do you see the evolution of private equity? Because there are a lot of pressures from the inflation, from the increase of interest rates, and even from the implosion of FTX, which is a small event, but might have an impact.
Yeah, so there's a lot there, and I take a step back and. What's private equity going to do, or what's any market going to do? What's the S&P 500 or the All Country World Index going to do in the next 12 months? Anybody that tells you with certainty it's going to do X, Y, or Z has no idea. Their view may be slightly more informed than mine, but it's mostly a guesstimate. But if you believe in the capital markets and you believe in the future over 3 and 5 year periods, that things generally be moving up, and these recessions come and go, and they can be very, very painful, but they usually draw down very quickly and bounce back up again. So I think you've got to say, well, what is going to be the call on my assets, and do I have the ability to lock them up for longer periods of time? And do I believe in a brighter future 3 and 5 years from now? And I think most people would probably say they're a little bit more bullish over the medium to longer term. So if I take that all in, and then look at maybe some more sort of statistical numbers. Preqin puts out a lot of very good research. They had their outlook recently, and they're expecting a doubling of the private markets in the next, I think, 5 years or so, 22
In terms
to
of
27.
what? Doubling?
Doubling. So from 9 trillion to 18 trillion.
Wow.
And this is just the private markets, excluding, I think, the hedge funds are out of that space. But even then, if you put the market cap of public equity and private equity in the denominator, and in the numerator you put just private equity, it's still less than 10% of the overall pie.
Yeah.
So it's still very, very small relative to the public markets. And I saw another interesting stat that I think Hamilton Lane put out, and I used this for my student tour also, Celine, in Europe. They looked at the companies in the U.S. earning more than $100 million of revenues, every single company they could get access to, public and private. 87% of the companies with more than $100 million of revenue are in the private markets, meaning only 13% are public. So I think we've got to think about less about capturing an illiquidity premium and really focus on where's capital formation and value creation happening. It's happening in the private markets. So we've got to find ways of investors getting greater access to that, because by the time companies come public, a lot of the valuation has been rinsed out. And in many cases, like Twitter as an example, put aside your feelings on Elon Musk, but we've got a lot of growth companies that were once public now being brought into the private sector well, where the average investor can't play in that space anymore. So I think it's a tale of two cities. I think there's opportunities there, but risks just at the same time.
Yeah, interesting, very interesting. And about ESG, do you see an impact, positive impact on private markets? Because there are, of course, a lot of regulatory constraints, very deep, not the same in the US compared to Europe or Asia, but there might be an impact. And what's your opinion on this?
Well, it's solving for ESG is almost impossible, because I think by saying we're ESG compliant, I'm not even sure what that means. ESG is not a single risk factor. There are so many risks tied into ESG, and am I going to be focused on E, environmental, and if I am I focused on emissions more than the environment as a whole, and then the S and the G, that I could be a coal-producing fossil fuel company here in the U.S., and I shut down an entire plant that is in one specific city or region, put a tremendous amount of families out of economic business, shut down an entire economic center in that town itself. And that doesn't sound like a very good answer to the S and maybe the G, but I solve for the E. So I think that's just one simple example that there's just trade-offs involved. And The Economist did a very interesting analysis of ESG, and they felt that we should change the E to environmental, and let's just focus on the climate side, because if we don't get that right, it's like sand in the hourglass, and we're running out of time. And I think we've got to decide how we're going to take all these disparate views and interests and try to turn it into a battering ram. And it used to be just UNPRI was out there fighting the good fight. Now it's become a cottage industry. There's so many associations and NGOs and even organizations like CAIA and CFA have certainly a table stakes in this game too. And I think we really have got to try to find a way of weaponizing our views and really making a difference. So back to your question on the private markets, if I think about solving for environmental challenges and emissions challenges, it's going to require patient capital. So what I do like about the private markets is that you're not trading in and out on T plus anything. If you are, it's T plus years. And I think that patient capital can hopefully be directed toward more responsible investing, more responsible solutions. And if I think about just real estate as an example, that if I'm buying a building today, I've got to be thinking about the implications of what it means for the environment, because I'm going to be long that building for maybe 7 to 10 years. And if I find out that I bought a wasting asset, I'm going to be in a world of hurt for myself and the constituencies that I serve. So we've really got to be thinking about these implications through a long-term lens. And maybe the last point on this is that there's something called the Data Convergence Project that has come out recently. And I'm not a student of this. It came up on a panel I was on recently.
Where is it coming from?
It's a consortium of both LPs and GPs in the private market space, and they've got a consultancy that has created an index to measure progress, and it's only focused on 6 factors, and one of the 6 factors is emissions. And there's going to be an index every quarter that comes out, and portfolio companies will be measured on how responsible they are. So the fact that it's only 6 metrics and one of them's emissions are all very good things. But then when it comes down to the emissions, there's mandatory requirement for reporting on Scope 1 and Scope 2. Scope 3 emissions, which are coming out of the supply chain, are optional. And so I think it sounds good in theory, but unless we get Scope 3 emissions owned and measured, we don't stand a chance either. So I think it's a step in the right direction. But I think if we're going to concede certain parts of the problem where nobody owns it, I think we do run back into a problem. So I think that this data convergence project is very, very new. I think it could be, perhaps, if we get the right eyeballs on it, perhaps a game changer, but it's a step in the right direction, especially when it's married up against private capital and patient capital.
Very interesting. Thank you very much. Oh, yes. One last question I had. We have time. About tokenization, because when we met 3 weeks ago, you were very bullish on tokenization of private equity and private assets in general. Can you say a few words about that? I'm very interested because I'm very bullish too.
Yeah, so I just got back from Miami. I should have stayed down there. It was quite nice, and it was snowing in Boston this weekend. But one of the discussions I had was with Zoe Cruz, who a very interesting and accomplished professional. She ran fixed income in a very traditional space for Morgan Stanley, a massive job for a good part of her career. And now she started a firm called Manai, which is focused on digital assets. So here you have clearly an adult in the room. Zoe's been around at least as long as I have, maybe slightly longer. So she has over 40 years of experience. And it was a very interesting discussion because this space, like you, Selena, interests me a lot. And now I'm talking to a serious, accomplished professional who grew up in the traditional markets and is now talking about the value proposition and acting on it too. And one of the things we talked about was not so much the FTX and the cryptos, and we can get into that, but more about the plumbing, the blockchain itself. And I mentioned earlier getting access to these private markets. And if you and I were interested for various reasons in a private company, and you for some reason wanted to get out and I wanted to get in, why do we need an intermediary between us? I know you, you know me. We can have price discovery on a blockchain, and we can settle it in the course of this podcast. It's a little bit more complicated than that, but one of the things that came up in the course of this conversation with Zoe was KKR came out with a recent fund offering. Very traditional alternative offering, private market offering, I think in the healthcare space, Cayman-based fund. But there's feeder funds hanging off of it. And one of the feeder funds is on the blockchain. Yeah. And I find that exceedingly interesting because the underlying asset, it's probably off-chain, tied to these portfolio companies. But the fact that it's on a blockchain where this B-REIT issue that came up a couple of weeks ago with Blackstone, where if investors went out, they have to gate the fund and raise liquidity. This blockchain offering, this feeder fund, they don't have to raise liquidity. You and I have to find each other. And if we find each other, then we can figure out how we're going to liquidate my holding and you're going to buy it. If we don't like the price, we move on. But the fund does not have to raise any incremental capital. So I think we're in the very early stages of this, but you could tokenize a building, a piece of artwork, it's any other intangible, as opposed to going and buying a company lock, stock, and barrel. So I think the camel's nose is in the tent. I can feel it. It's wet. And I think when the rest of that body comes in, it's going to be a game changer to our industry.
Yeah, clearly this is something that I've covered several times on my podcast. And more recently, we talked with Taurus Group, which is a Swiss-based fintech company, about the tokenization of real estate and one specific real estate group in Switzerland. And that's very, very, very interesting because it opens so many doors. That's impressive. So as you said, you are the CEO of CAIA Association. So I wanted maybe that you take 2-3 minutes to explain to us what is CAIA Association, because it's for me it's very interesting and very exciting because it's quite a recent one. I would say like 20 years ago. You said, compared to CFA.
Still young.
CFA is very old compared to CAIA.
Yeah, so it's and it's funny even looking at the CFA. The first charter holder at the CFA rolled off the assembly line in the early 1960s, and the first charter holder at CAIA was about 40 years later in about 2002. And the CFP came along somewhere in between that, and FRM, and the credentialing list goes on and on. But an important distinction is that the first mutual fund here in the U.S. was in the 1920s. Mass Financial. And the first mutual fund in the Eurozone was my old company, Robeco, also in the 1920s. And then the concept of trading in places like the Netherlands goes back to the 1700s. So we're trying to retroactively professionalize a very complex and global industry. So can we ever be a profession? I'm not so sure we can, but can we have more responsible professionals hopefully running these organizations? I say absolutely, and that's our charge. So CAIA is a non-for-profit. So we are a bit mission-based. We have 13,000 members in over 100 different countries, 6,000 people that sit for our high-stakes exam every single year. Those numbers are coming roaring back, and I think it's a good indication about this concept of what I now have coined educational alpha, where you can get return, but you have to approach these asset classes with a tremendous amount of education. So it's nice to see that these numbers are coming back, and we're ultimately trying to bring forward a better value proposition for the end client. If we have more responsible, fiduciary-minded professionals that understand what alternatives are, they can approach these on behalf of their end client, and the outcome should be far better than just somebody saying, well, I need to go get me 30% of alts because I don't like the 60-40 model anymore. I wish it were that simple. It's not. So I think that our very best days, opportunities, challenges, ability to contribute to a broader ecosystem are ahead of us. We're still young, as I said, 20 years old, but I think we're just getting started. And there's something new to talk about every single day. And if I think about my 40 years in this industry, I would say the first 35 were kind of placid. I could have taken 2 years off and gone to the beach and come back and plugged right in and not miss a beat. I think if you miss one quarter of what's going on in this industry, you could very quickly find yourself marginalized. And this next generation coming up behind us, very tech savvy, tech natives. And the concept about blockchain and tokenization we talked about a moment ago, I think there are many people in their 40s, 50s, and early 60s that they may know the buzzword, don't quite know what that means. And if they're going to figure it out by the time they get disrupted, they're going to get steamrolled over and their career is going to be done. So I think there's tremendous opportunity, but we have to be constant students of this market. And that's what CAIA does every single day.
And what is CAIA Charter Program? What is the content of it?
So we talked about the institutional quality of alternatives earlier. So though we certainly cover those more on a bottom-up basis in our level one. So what is a hedge fund? What are real assets? What are structured products? And then level two is much more of a top-down view in terms of what does the allocator think from the CIO office, and how do they allocate to alternative investments? How does it fit into portfolio management? What are some of the risk management tools? How do they use modeling to effectuate the portfolio they're looking to have at the end of their journey in terms of their investment policy statement? So we're really trying to educate the professional, and even if you're in the business of a single product like a hedge fund or private equity, you may say, well, why do I need to understand this full gamut of alternative investments? And I think the answer is a very clear and simple one. Put yourself in the shoes of the end client. And if you want to go and get your product into their portfolio, something else has to come out. It's a zero-sum game. So being able to have a conversation with the CIO about, okay, here's my product, but let me first hear about what your needs are. Do you have a blind spot in hedging? Are you over-allocated here or under-allocated there? And sometimes the answer might be, well, this is a very good discussion, but my product simply doesn't fit into your portfolio today. If we were a profession, that would happen every single day. We're not, and it happens in fantasy land. It does not happen in the asset management space. So I think putting the client first and understanding fit for purpose of your product makes our curriculum germane to virtually everybody out there.
And who are your 13,000 alumni? Who are the investment managers, analysts?
Yeah, so it's interesting, and here's an important distinction between CAIA and the CFA. So the CFA really is focused on the analyst who is working at the buy-side asset management company and trying to use a dividend discount model to figure out the value of a particular public equity holding. We were focused very much on the asset owner. the asset allocators, the sovereign wealth fund CIO. And our early members came from the big investment offices and then also from the pension consultancies. Because if you think about the pension consultant, they're working for the large plans and trying to figure out how to effectuate an asset allocation mix across a broad array of products. But over time, the point I made earlier, I think a lot of these asset management professionals who may work for a private equity shop or a hedge fund shop really have now understood that they have to have a better understanding of the gamut of offerings, not because they have them, but the client is thinking about this broader buffet of potential opportunities. So I would say now it's a combination of asset owners, consultants, investment professionals, and even service providers. If I'm a hedge fund accountant, I ran into somebody in Miami. They had a breakout session with 15 people, and I said hello to him. He said he was a CAIA member. I looked down his name tag. He works for the SEC. So I said, this must be interesting. When you sit down at one of these round tables, you could be a little bit of the skunk at the picnic because you got the SEC listening to your pitch. And this fellow was very, very balanced. And I think ultimately an educated regulator is better than one that's not. So it's nice to see adoption in places like the SEC, the SEBI, we have members, the FCA, we have members. So we take all comers. And if we could get every single person in this world holding the CAIA credential who are working in financial services, the world would be a much better place. Not so much for me, but for the end client. And that's probably not an achievable goal, but we want to make sure that we make inroads to every asset manager, asset owner, make sure they understand the value of what we do.
That's true. And can you say a few words about the DEI initiative on diversity that you launched recently?
Yeah, a very important one, and we certainly, I feel, have done a decent amount, but there's always a lot more to do. Debbie McLean is now the president of our foundation. She's been in that role about 3 or 4 years, and she is our chief DEI officer. So she's gotten very involved in how CAIA is going to make a difference in this space. We've established partnerships with the Milken Institute. Wall Street Bound, which is an organization many of your listeners might not know, but it's an organic one based right here in the Northeast in New York, started by a CAIA member, Troy Prince. I'm having coffee with him in New York tomorrow. And Troy is trying to bring greater diversity into the space. He worked in financial services most of his career overseas in places like Japan and Vietnam, goes back to New York and looks at asset management and says, where are all the Black and brown people? We need to do something about this. So Troy is a very small organization, one that I personally contribute to, and we try to support as best we can too. But then there are challenges. I was at a conference just this past week, and first off, I've never seen a panel with 6 panelists and a moderator, full stop. But here was a panel with 6 panelists, all white men, and a moderator who was a white man. And I just
surprising.
think that's it's not even it's a bad look. It's but people say I can't find enough women. I reject that notion. But I don't even know how you could find 6 capable white men to get up there. So I think that we have got to try harder. And I made a pledge several years ago that if I'm going to be on a panel, I simply will not sit on it if there's not at least gender diversity, full stop. And we need to have this take this further, because it's not a fashion statement. It's that we have very smart minds across all forms of diversity. So race, gender, age, background, experience. And to say, well, this is the best I could do, I reject that notion. We need to take a stand and do better. And ultimately, if you think about the investors coming up into this industry, more diversity, more women balance sheets that we're investing on behalf of, more minorities that we're investing on behalf of, we've got to make sure that we are reflective of what this next generation looks like and what they want and where we're thinking. And then maybe the last point, if you think about any contagion or risk, it's all the same minds doing the same thing at the same time.
Yes, that's true.
So if a bunch of white males that all went to the same Ivy League school, all same fraternity, played for the same rugby team, are they going to all think the same? Yes. And you have to have diversity. It will de-risk most things in life. So we continue to push on this. We try to lead by example. We're still a small organization, but it's something we feel very, very strongly about.
And what are your next steps at CAIA?
Next steps.
Yeah.
So 2023 is going to be a very interesting year for the aforementioned reasons, but we didn't get into, and this can maybe be another podcast, Celine. I think about democratization And this is true around the world, but most notably here in the US, where if I look at my parents' generation, my dad is still alive. He's 92 years old. He worked for the same company his entire career, retired when he was younger than I am today, and gets a defined benefit check, meaning that there's a check in his mailbox every single day. He may watch CNBC, he may not, he may watch Bloomberg, he may not, but he doesn't have to worry about recession, inflation, longevity risks. Somebody's taking care of that for him. That's true for our generation. So CAIA has a 401k plan. I invest part of my earnings in there. CAIA puts a match against it, but then I've got to decide which investment options I'm going to invest in. And if I look at those investment options, not a single one of them is alternatives. There's no private equity. There's no real estate. There's no infrastructure. So how do I get access to where the value creation is happening? We've got to get that fixed. We've got to get it fixed responsibly. And for some of the reasons I mentioned before, that we're going to say investors, we'll just give you access, it's going to end badly. So we have to figure out how we're going to grant that access where the capital formation and value creation is happening. So we see this is a bit of a freight train coming down the tracks. Eventually, we see the SEC and the Department of Labor loosening up definitions of accredited investor, loosening up definitions of what can go into a target date fund. So we created a new platform called Unify. My colleague Aaron Philback is heading this up for us. And it's going to be a series of micro badges that are focused on more of the mass affluent population, where the RIA, the Registered Investment Advisor, might have a client or prospect coming to them and saying, tell me about digital assets. Tell me about cryptocurrencies. Tell me about private capital. And these might be asset classes that this RIA either knows nothing about or knows very little about. So we're going to create a series of these micro badges to try to constantly be in a position we can fill in these learning gaps. And this isn't going to be the only answer. We want to be part of this ecosystem of solving for blind spots around democratization. And this unified platform is brand new for us, but that's something we're going to put a lot more lean into as we get into 2023. And then the last initiative, which we launched right before the COVID crisis happened, was something called FDP, Financial Data Professional. And this gets back to something we talked about a moment ago, Celine, where in the good old days, if I looked at an investment process, I had a CAIA CFA, maybe a CFA, and then if they thought about hiring a new person, they would go to the competition or maybe the B schools. Yeah. Now these asset managers are hiring people from NASA, from Google, from Apple, with data science backgrounds, and they're working with artificial intelligence, machine learning, natural language processing, and all this old data. And how does the analyst banging away in Excel work with the data scientists working in Aura Python? So we created Financial Data Professional Institute and a new FDP credential to try to fill that white space. It's early days, but we're working with my former colleague who's on the board when I joined, Jane Buchanan, to try to create also not only this high-stakes exam, but a series of micro badges in the space. And this gets back to your earlier point about DE&I, where most of the headcount in asset management are in the middle and back office. And most of the diversity in our industry is in the middle and back office. And the disruption around T+1 or T+2 going to T+1 second, as we talked about before, is upon us. And we're working on a micro badge there where we can cross-skill and upskill the spot in our industry where we have the most diversity to begin with. So we want to play into that as well. So we've got a couple of very interesting things. We're going to try to be very, very focused on a narrow agenda because we have a limited amount of headcount, a very small balance sheet. But I think if we can have the right partners and the right focus, we can make a difference.
Impressive. Impressive.
We'll see.
I was not expecting this for the end of the discussion. Before closing the discussion, which book would you recommend to the audience?
Well, so a couple of things. One is the last book I read cover to cover was the CAIA curriculum. I just took and passed level 2 earlier this year. Not for the faint of heart and certainly not for somebody in their early 60s, but I'm glad I did it. I travel a ton, but given COVID, I was able to get I was off the road for a bit. It's picked up again, as we saw when I saw you last week or 2 weeks ago in Luxembourg. But that's probably the last book I read cover to cover. And it's interesting. I'm a student in these markets every single day. And what I love about my job is I learn something new every single day. So most of my reading is The Economist, the Wall Street Journal, the FT, and my ability to read for leisure is limited. But I will say, Howard Marks at Oaktree. He's written 2 books. His first book, The Most Important Thing, is a compilation of his memos. I have that sitting on my desk upstairs. He's come out with the second one, which is a compilation of his next generation of memos. But some of the ones he's written very recently about what really matters as an investment, or as an investor, more importantly, are just easy reads. They're maybe 12, 15 pages long, but approachable by virtually anyone. And I think he's just a very good writer. He's a very good student of the market. And I would recommend his memos, his first book, and his second book. And one of the quotes I'll leave you with is, as an investor, we should trade less and think more. And I think if we followed that philosophy and thought about the long term, we'd all be much better off as people, as investors, and would sleep better at night.
Thank you very much, Bill. Very insightful.
It was a pleasure. I appreciate it. Was, I guess, a happy happenstance and a great happenstance for me to have met you in Lux, and it was a great honor to be on here today.
Thank you very much. Bye.
Stay well. Thanks, Celine.
Thank you all for listening and sharing this moment with us. Don't hesitate to contact me on Twitter or LinkedIn to share your comments and reactions. You can also rate this episode on your favorite podcast platform. See you soon.